There are five specific IRS forms that the average American senior born before 111971 has never filed in their entire life. And every single one of them could be worth thousands of dollars back in their pocket before June 30th. Five forms sitting on the IRS website right now, completely free, available to every senior born before 1971. And almost nobody is using them because almost nobody has been told they exist. Before I go one sentence further, I need to clear up the single biggest misunderstanding because it is the reason most seniors click away and leave thousands of dollars sitting on the table unclaimed. Some people assume a video about IRS forms is only for seniors who are struggling financially. So if they are comfortable, they tune out. Others think it is some advanced wealth strategy only useful for wealthy retirees with complex portfolios. So if they are living mostly on Social Security, they tune out. Both of those assumptions are completely wrong. This list is for every senior born before 1971. Whether your entire income is a Social Security check or you have a pension, savings, and a home that has tripled in value since you bought it, there is real money sitting in these five forms with your name on it. The reason almost no one tells you about these is straightforward. The IRS does not advertise tax savings. Your CPA does not get paid extra to file forms you could fill out yourself. And the deadline matters. June 30th is not an arbitrary date. For several of these forms, missing the window means waiting a full year to recover money that is already legally yours. So today, I am going through all five one at a time in plain English. Form number one is coming up in a few minutes, but stay until the very end because form number five is the most powerful of all five, and it is the one form that almost no senior even knows exists, and it has the highest dollar impact per month of anything on this list. Here's the uncomfortable truth about these five forms. The IRS does not call you to file them. Your tax preparer does not include them automatically in the standard return. Every form on this list either reduces what you pay or speeds up what you get back, which means the systems that collect your money have little financial incentive to stay quiet, but also no obligation to speak up. Think about it. Every dollar you do not claim is a dollar that stays in the system. That is not a conspiracy. That is just how a passive tax code works. It rewards the people who know to act. It quietly takes from the people who do not. And there is another reason these forms go unfiled. Most seniors were told their whole lives that the IRS is not someone you want to mess with. So they hand the paperwork to whoever charges the least, sign where they are told, and hope for the best. The problem is, hope is not a tax strategy. If you have ever wondered whether your tax preparer is filing everything you qualify for, drop a comment below right now. It helps me understand who is being served well and who is being failed by the system. This video is for educational purposes only and is not tax or legal advice. Tax laws are complex. Always consult a licensed CPA or enrolled agent for your specific situation before taking any action. And before I give you form number one, here is what I want you to picture. At the end of this video, I'm going to walk you through a real scenario where one of these five forms saved a retired couple in Arizona more than $5,000 in a single year starting the month after they filed. They had no idea the form existed. Stay with me. Every form I am about to show you is verified directly from irs.gov or ssa.gov. I am going to give you the exact form number, the exact purpose, and exactly where to find it so you can verify it yourself before you do anything with it. Everything is real and waiting for you to claim it. Form number one. This is the single most ignored form in the entire IRS catalog, and it is the one that puts the most cash back into your monthly check the fastest. Form W4P, available free at irs.gov. It controls how much federal income tax is withheld from your pension, annuity, or IRA distributions every single month. Here is the problem. When most pension programs and IRA custodians set up distributions, they either withhold at a default rate that is almost always too high, or they use a generic calculation that assumes you have more taxable income than you actually do. So what happens? Every month, they hold back more than you actually owe. Then, in April, you get a refund, and you feel good about that refund. Most people do. But here is what that feeling is actually costing you. That money was yours all year. You just gave the government an interest-free loan for 12 months. Take a retiree. Let us call him Harold. He is 66 years old, single, living in Georgia. He has a $38,000 annual pension. His custodian is withholding 10% automatically. That is $3,800 a year held back. But because Harold is 65 or older with the additional standard deduction for seniors and the new senior bonus deduction, his actual federal tax liability on that pension is closer to $1,400, not $3,800. That is $2,400 he has been loaning to the government every year for free. That is $200 a month that should be sitting in his bank account, not at the IRS waiting for April. Form W-4P is how he fixes it. He downloads it from irs.gov, fills out the withholding worksheet, and submits it to his pension administrator or IRA custodian. His withholding adjusts the next month, not next year, the next month. That is how fast this particular form works once it is filed. Quick question for the comments. Are you currently having federal tax withheld from your pension or IRA distributions? Yes or no? I am building a follow-up video specifically on how to calculate the right withholding amount for different retirement income situations. And your response tells me exactly how many people need that. Form number 2. This one is for anyone collecting Social Security, and it is the form that decides whether the government holds your money for an entire year and gives it back in a refund, or whether you get the right amount deposited into your account every single month. Here's something most seniors do not know. Social Security payments arrive with zero federal tax withheld by default. Not 5%, not 10%, zero. Now, for some seniors, that is perfectly fine. If your combined income is low enough that none of your Social Security is taxable, no withholding is exactly right. But for millions of seniors born before 1971 whose Social Security is partially taxable, that zero withholding creates a nasty and painful surprise every April. They owe more than they expected. Sometimes they owe significantly more. And in some cases, they get hit with an underpayment penalty on top of the tax bill, all because they did not know Form W-4V existed. Form W-4V allows you to choose your Social Security withholding rate. You have 4 options to choose from: 7%, 10%, 12%, or 22%. That is the complete list. You pick the rate that most closely matches what you actually owe based on your income picture. Here is why this matters in both directions, and I want you to hear both sides of this. Some seniors are under withheld. They end up with a surprise bill in April that they had no way of planning for. But some seniors are significantly over withheld. They chose 22% years ago when their income was higher, and now they are overpaying by hundreds of dollars a month when their actual rate is much lower. Dorothy is 70, married, and she and her husband both collect Social Security. Their combined benefit is $34,000 a year. Her husband set up 22% withholding several years ago when their income was higher. Now, with their current deductions and income level, their actual tax rate on that Social Security income is closer to 9%. They are overpaying by approximately $2,200 a year in withholding. That is more than $180 a month that should be in their checking account right now, paying for groceries and prescriptions and utilities. A new Form W-4V sent to the Social Security Administration fixes it. You can submit it directly online through your My Social Security account at ssa.gov, mail it to your local Social Security office, or bring it in person. It adjusts your withholding going forward from the month it is processed. Now, here's something I have not said yet about this list. 2 of the 5 forms are specifically designed for seniors age 65 and older, not for general taxpayers, not for working adults, specifically for you, the person born before 1971, who has reached or is approaching that age threshold. I will get to both of those forms, and one of them is form number 3. Form number 3, this is the form that was literally built for you. Form 1040-S. The IRS created it specifically for taxpayers age 65 and older, and millions of seniors still file the regular 140 every single year, completely unaware that a version designed for their situation exists. The 1040-SR has larger print. That matters for practical reasons. But the important part is not the print size. What matters is what is built into the structure of the form itself. The 1040-SR has a dedicated section for calculating the additional standard deduction for seniors age 65 and older. It has a cleaner and more intuitive layout for reporting Social Security income and pension distributions, which are the two most common income sources for people in your age group. And importantly, it has the built-in sections for the senior bonus deduction that many tax preparers and software programs do not flag automatically on the regular 140. You can technically claim everything on the standard form. But the 1040-S is designed so that the deductions and income categories most relevant to your situation are in front of you, not buried in schedules and worksheets that a standard filer would never need to navigate. Here is the action step. If you use a CPA or tax preparer, ask them one specific question before you sign your return this year. Are you filing my return on Form 1040-SR? If the answer is no, ask why not. If they cannot give you a clear and specific reason for using the regular 140 instead, that is worth a follow-up conversation. If you file your own taxes using software, look for the option to switch to Form 1040-SR before you submit. Most major tax software programs support it. It may be listed under Senior Return, or you may need to confirm that you are 65 or older in the Profile section, which triggers the software to route you to the correct version. A reminder, this video is educational only and not personalized tax advice. Always consult a licensed CPA or enrolled agent for your specific situation. Form number 4. This is the form that prevents you from being taxed twice on the same dollar. And it is the one that retirees with IAS are quietly losing tens of thousands of dollars to. Not because of anything illegal or complicated, but because nobody tracked a number that should have been tracked years ago. Here is the situation. When most people contribute to an IRA, those contributions are tax deductible. You put money in, it lowers your taxable income for that year, and you pay tax when you take it out later. That is a traditional IRA, and the tax treatment is straightforward. But some people, particularly those whose income in certain years was above the deductibility limits, made what are called non-deductible IRA contributions. They put after-tax money into the IRA, money they already paid income tax on. Here's the problem. If nobody tracks that after-tax amount, which is called your IR basis, then when you start taking distributions in retirement, the IRS treats every single dollar coming out as if it were pre-tax money, and they tax it again. You have just paid income tax on the same dollar twice. Once when you earned it, once when you withdrew it. And you may have no idea that is happening. Let me give you a concrete example. Over the course of his working years, Robert made $45,000 in non-deductible IRA contributions. He never filed Form 866 consistently, and neither did the accountant he used during those years. Now he is 68 years old and taking required minimum distributions. Because there is no documented basis on file with the IRS, his IRA custodian reports the full distribution as taxable income. He is being taxed on $45,000 that he already paid tax on at a 22% federal tax rate. That is $9,900 in taxes he never should have owed gone permanently unless he or his current accountant goes back and addresses it. Form 866 is how you document your IRA basis. You file it with your annual tax return for any year you make a non-deductible IRA contribution. And here's what most people do not know. If you have made past non-deductible contributions without filing Form 866, you can file amended returns to establish and document your basis going back to the years those contributions were made. This form is also critically important if you have ever done or plan to do a backdoor Roth conversion, where you contribute to a traditional IRA and then convert it to a WTH. Without Form 8606 on file, the IRS has no record that the original contribution was non-deductible. The conversion looks fully taxable on paper when it should not be, and you end up paying tax twice on money that was already taxed once. If you have contributed to a traditional IRA at any point in your working life, and you are not certain whether all of your contributions were deductible, This is a conversation worth having with your CPA before June 30th. Pay attention to what comes next because form number 5 is the highest dollar value form on this entire list for the seniors who qualify. I told you at the beginning of this video that there was one form almost nobody knows exists. This is it. I want to be honest with you about something. There is a part of this that feels like talking myself out of a job because the more clearly I explain these forms, the less you need someone like me to walk you through them. But you earned this money. You should not have to pay $300 to a professional to file a free IRS or SSA form that takes 20 minutes to complete. Form number 5, this is the most powerful form on this entire list. If you qualify, it could put thousands of dollars per year back in your pocket starting as soon as next month. And to understand why it matters so much, you need to understand something called IRMA first. IRMA stands for Income Related Monthly Adjustment Amount. It is a Medicare surcharge charge, an extra charge added on top of your regular Medicare Part B premium that hits beneficiaries whose income exceeds certain thresholds. Here is how it works in 2026 based on information from the Centers for Medicare and Medicaid Services, which is cms.gov. The standard Part B premium in 2026 is $185 per month for most beneficiaries. But if your income from 2 years ago, specifically from your 2024 tax return, exceeded certain levels, Medicare is charging you significantly more than that right now. For single filers, IRMA search charges begin when your modified adjusted gross income exceeds $16,000. The first search charge tier adds $740 per month to your premium. As income rises through higher tiers, the additional charge climbs from $74 per month up to $443 per month per person. For married couples filing jointly, the income thresholds are double those for single filers, and the search charges apply to both spouses separately, meaning the potential combined annual cost to a married couple can be substantial. Here is the trap that catches retirees specifically. And this is the part that most people never figure out unless someone explains it to them directly. Medicare does not look at your current income, it looks at your income from 2 years ago. So if you retired in 2024 and your income that year was elevated because you worked for the first 6 or 8 months of the year, or because you sold a business or took a large IRA distribution or received a pension lump sum payout, Medicare used that elevated 2024 income to set your 2026 premiums. Even though your income dropped dramatically when you retired, even though you are now living on Social Security and a small pension that is a fraction of what you earned in 2024, you are still paying an IRMAA surcharge based on income you no longer have and will never have again. That is not fair. And the Social Security Administration, which manages Medicare premium billing, built a specific correction mechanism directly into the system for exactly this situation. That correction is Form SSA 44. Form SSA 44 is a life changing event appeal. It is how you tell Social Security to use your current income when calculating your premium rather than the 2 year old income figure that no longer reflects your actual financial situation. There are 8 qualifying life changing events that make you eligible to file Form SSA 44. The first is marriage. The second is divorce or annulment. The third is the death of your spouse. The fourth, and this is the most relevant one for most retirees, is a work stoppage, retirement. That is it. You stopped working. That alone qualifies. The fifth is a reduction in work hours or income. The sixth is the loss of income rousing property, such as a rental property you no longer own. The seventh is the loss of pension income. And the eighth is receipt of an employer settlement payment in a prior year that temporarily inflated your reported income. Now, let me walk you through the real scenario I promised at the beginning of this video. The Arizona couple who saved over $5,000 in a single year starting the month after they filed. Their names are Frank and Carol, both 67 years old. Frank retired from his engineering job in June of 2024. Carol retired from her school district position in July of 2024. For the months they worked in 2024 before retirement, their combined income was elevated. Frank's modified adjusted gross income for 2024 came in at $138,000 and Carol's at $122,000 because Medicare looks at 2024 income to set 2026 premiums. Both Frank and Carol were hit with IRMA surcharges. Frank was placed in the second IRMA tier, adding an extra $259.20 to his monthly Part B premium. Carol was placed in the first tier, adding $740 to hers. Together, they were paying over $330 per month in combined IRMA surcharges on top of their regular premiums. Their actual income was $52,000 combined, Social Security for both of them, plus a small pension from Carol's district. They were paying premium surcharges based on income they had not earned in nearly 2 years and would never earn again. Frank filed Form SA-44, checking the work stoppage box and documenting his projected 2026 income. Carol filed the same form for her own account. Both submitted documentation showing their current income situation. The Social Security Administration reviewed both appeals. Frank's premium dropped back to the standard rate. Carol's dropped back to the standard rate. Their combined monthly savings came to more than $330 per month. Annualized, that is over $3,960 in premium savings for the year. And because they filed early in the calendar year, they recovered surcharges that had been paid going back to January. Total savings for the year exceeded $5,000 for the couple combined, one form each. Available for free at ssa.gov, 20 minutes to complete per person, $5,000 recovered. Form SSA-44 is available directly from ssa.gov. You can submit it online through your My Social Security account, mail it to your local Social Security office, or bring it in person to the office nearest you. You can also call the Social Security Administration directly at 1-800-772-1213 and request the form by phone. The correction, once approved, typically takes effect within 1 to 2 billing cycles. Most seniors never file this form because most seniors have never heard of it. And now you have. That is the entire reason this video exists. Now let me pull everything together and give you the priority order for what to do before June 30th. Form W-4P, which controls pension and IRA withholding, is available at irs.gov. Download it, complete the withholding worksheet, and submit it to your pension administrator or IRA custodian. This is the right starting point for anyone receiving monthly pension or IRA distributions who suspects they are withholding more than they actually owe. Form W-4V, which adjusts Social Security withholding, is available at ssa.gov. Submit it online, by mail, or in person to your local Social Security office. This is essential for anyone whose Social Security is partially taxable and who wants to avoid an April surprise, or for anyone who suspects they are currently over-withheld and losing money every month. Form 1040-S, the Senior Tax Return, is available in all major tax software programs and directly at irs.gov. If you were born before 1961, this is your designated form. If you use a preparer, verify that they are using it. If you file your own taxes, confirm that your software is routing you to the senior version. Form 866, which tracks IRA basis, is filed as part of your annual tax return. Clears throat. If you have ever made non-deductible IRA contributions or done a backdoor Roth conversion, this form is legally required to protect your basis.